Hey guys, thanks for tuning in. Before we get started in today's video, don't forget to join our free Facebook community, get real answers to real credit questions, learn from some of the experts in our industry, as well as from other people that are in similar situations that are taking advantage of the free content, improving their credit and making their credit situation better. Hope to see you guys on the inside.
So why do lenders consider you high risk when you have a good credit score? Well, we're going to unpack that and more in today's episode of The Credit Agent Show. So, would you believe that having a high credit score does not guarantee you a loan? It is possible, and we have definitely had previous clients come in and talk to us about them having a high credit score but still not getting approved for the loan they are applying for. So an example of something like this happened is Diane Elizabeth. She is an entrepreneur and a skincare blogger. Mentioned how she was rejected for a credit card even though her credit score was well above a score of 750. She later discovered that it was because of 2 late payments that were found on a report, only to find out that her bank's autopay feature had glitched. Even though that incident had happened 5 years before, this rejection, it still affected her. She later went on to dispute the information and reapplied for the credit card. This time, she got approved. So the reason, as I previously mentioned, that Diane did not get approved was because of those collections on her report. Now, even having just one collection on your report can drastically affect the way that lenders will view you, even if you have a credit score that's high. Case in point with Diane. So it's super important to take a look and monitor your credit report regularly and find out if you have any of these super old collections on your report that you don't know about. They could even be linked to previous names or addresses, and if you get those names and addresses removed so that you only have your current name and current address, should only be one name and one address, on your credit report, it makes it a lot easier to dispute later on those collections. So, talking about some of the late payments that could be found on your credit report and what they can do to your qualifications for a loan, say a 30-day, delinquency late payment appears on your credit report. That could drop your score more than 80 points. And for Diane, this would drop her into a completely separate category when it comes to her credit score, being in a score range of 600. Now, if you declare bankruptcy, and that is listed on your credit report, that is going to drop your score a whopping 240 points or more, which could financially set you back a bunch. So missed payments such as that first 30-day collection will generally stay on your credit report for around 7 years before they fall off. So even if you pay them off later on, you're still going to have to deal with that, which is why a lot of people, and we recommend you do this, is to dispute them. Take a look at your credit report. If they're linked to that previous name or address or a completely separate name or address, get those removed off your credit report first and then dispute the collection. It makes it a lot easier to get it removed once those addresses that it's linked to are no longer associated with you. A bankruptcy, on the other hand, will take 7 to 10 years to fall off your credit report, which, even if it's a legitimate bankruptcy, you're having to deal with that credit score deficit for around 10 years. So another reason why this might happen is you've overextended and or you are inexperienced. Now, what do I mean by overextension? Well, if you've seen one of our previous videos where we've talked about hard inquiries, if you apply for too many loans in a short amount of time, no matter the credit score you have, that is going to apply multiple hard inquiries to your credit report, which can lower your credit score and evaluate you to be higher risk when it comes to lenders viewing you. Now, this will happen a lot of the time when you have a good credit score and you get declined. It's because you are high risk, and this is the leading cause of it happening. So issuers will also be hesitant to lend you credit if you haven't had credit in a long enough span of time. Now, history of credit is going to take up a pretty significant portion of your credit report, being 15%. So if you do not have a long-term history using credit or credit cards, it may be harder to get a application approved further on. Now, you can even have a fantastic credit score but get declined because of this. So what we recommend is if you have any old credit cards or loans that you're still working on paying off and you've been thinking about canceling them, don't. Keep them around, because the older those credit cards are, the better they will work for you and raise your credit score if you use them. Just make sure to spend 1 to 7% of the total available credit on those cards each month so you do not risk them getting closed. So another reason why this may happen is because you don't make enough money. A lot of lenders will actually look at your salary in consideration for the type of card you're getting. And in general, you should not be applying for any new lines of credit that are more than 28% of your total available income. The reason for this is because if you go above that, generally lenders will look at you and consider you higher risk, giving you too much credit to play with when you don't have enough money to pay it off. One thing you want to make sure of is that you're not a card churner. Now, what exactly is a card churner? It is somebody who is chasing after strictly just the rewards for brand new credit cards. Now, this kind of bleeds into those hard inquiries I was talking about previously, where these people will apply for a brand new credit card. Generally, those ones that have crazy bonuses if you spend a certain amount of money within that introductory period, generally around 2 to 4 months. And then after they get the rewards, they cancel the card and apply for a new one, chasing those rewards once again. That can drastically lower your credit score and evaluate you as higher risk when it comes to future lenders looking at you. So a lot of companies that are issuing cards have come out with prevention techniques against card churners. And one of them is Chase. And they actually decline any applicants that have 5 or more card applications within the last 2 years. So that's important to note as well. Now, if you're applying for new lines of credit, it is so important, once again, that you space them out. Not only just for applications like this, where Chase, actively monitors the amount of applications you do each year, but also for the sake of your hard inquiry checks, because those will build up and lower your score as well. Alrighty, so that is about all we have for today. I hope you guys learned something today, and if you liked, make sure to give us a thumbs up and be sure to comment something down below. We'd love to hear from you guys, and any questions that you guys may have about credit or the video, we could address in a future video as the brand new topic. So thank you guys once again for tuning in. This is Michael with the Credit Agents, and we'll see you next time.